Hey guys, I'm going to do a quick video for you today to answer the 4 biggest questions people have right now surrounding COVID-19 and the real estate market. Some of you guys know I have a background in interactive media and web code, so that engineer brain in me likes to get data. I love to gather information, but you guys also know it's got to be accurate, credible, and from the right source. So that's what I've got here for you guys today. I'm going to share some slides, and anything I share I will put as a download here for you, so you can grab that when we're done. Originally I was going to break this up into 4 parts because I'm not into super long videos, but a lot of you guys are going to want this information, so we're going to dig in for about the next 8 to 10 minutes. I'm going to talk really fast, but you got the tape so you can play it back, rewind it, play it back slow if you need to. Also, I'm going to keep it posted here so you can just come back at your convenience whenever you want to take a look. All right, so with that being said, let's get into the first question. Okay, so the first question is, what's all this going to mean to the mortgage rate? When the recent emergency rate cut happened, I was getting a ton of questions that day on how it was going to impact the rate, and several people thought they were about to get a home loan at 0 or 0.25%, and some people were even being told that by their agents, which we know wasn't the case. So after explaining that a few times, I reached out to my preferred lender, Larry, and I shared a video. I had him explain it in a way that people could understand, and I sent that out the next day, or I think maybe that following Tuesday morning I sent that out. But just so you know, Larry's pretty much the Yoda when it comes to the mortgage industry, and so I'm not going to dig too deep into this one, but I did want to share a couple resources with you guys about that. So when we see money coming out of the stock market, typically what's happening here is that money is flowing into the bond market. If we look at the relationship between the 10-year treasury and the 30-year fixed mortgage rates, we can see that they tend to track almost in unison. But recently that wasn't the case, as we saw with the recent rate cut. The thing we have to take into consideration is the big picture and what's happening in our economy right now and all the forces that are in play. Right now, the mortgage rates are still at a historic low, but since the rate cut, it has increased from that all-time low that we hit a few weeks ago. But the thing is that the rate is really volatile right now, and like we've seen recently, it's subject to change daily and multiple times throughout the day. So I think today we're sitting at about 3.9, and it's been fluctuating between that 3.9, high 3s and low 4s. So a lot of people are taking the opportunity to lock rates in, which is a smart move. A lot of lenders, like my preferred lender, will lock those rates in. That protects you from the increase. And if it drops, you can always reassess at no cost to drop your rate down if it goes back down, or when it goes back down. We just don't know how low it's going to go. But if you don't get your pre-approval locked in right now while the rates are still low, you do it days, weeks, months from now. When it's increased, and you're subject to whatever the rate is at that, the daily rate is at that time. So a lot of people are locking in while we're still low, just because the market's so volatile, like I said. But if you have any questions about that, like I said, Larry's the guru. Okay, before we move on to question number 2, I want to share a statement made by First American Financial Corporation's Deputy Chief Economist, Odetta Cushy, and she says this: as evidenced by recent events, often the spread increases because mortgage refinance application processing capacity cannot meet demand. So lender offered rates don't follow the treasury yield down 1 for 1. So while the mortgage rate has declined in response to the decline in yields, it is unlikely to fall by the same magnitude as the treasury yield. It is plausible that mortgage rates fall further if the benchmark 10-year treasury bonds yield decline further. It's reasonable to expect that rates will fall even further and likely surpass the prior record low, but not necessarily 1 for 1 with the 10-year treasury yield. All right, guys, so with everything that's going on, it's important to have somebody in place that knows their stuff, somebody that you can trust and who stays on top of what's going on a day-to-day basis. All right. Now, number 2, are we headed for a housing and mortgage crash? This is one of the biggest questions on people's mind. Are we about to see 2008 all over again? That's something that we could unpack for a couple of hours, but I'm just going to dig right into some numbers that's going to help bring some perspective to our current situation. Now, when we take a look at the housing and mortgage crash of 2008 and the S&P correction and compare it to the annual home price depreciation over that span of time, we can see nearly a 20% depreciation. Now, before I share a slide that puts the .com and the 9/11 crash side by side to 2008, let's take a look at a quote from economist David Rosenberg. What 9/11 has in common with what's happening today is that this shock has also generated fear, angst, and anxiety among the general public. People avoided crowds then as they believed another terrorist attack was coming, and are reacting the same way today to avoid getting sick. Same parts of the economy are under pressure, airlines, leisure, hospitality, restaurants, entertainment, consumer discretionary services in general. So the housing crash occurred in 2008 because of a perfect storm that we really created within our own economy. What we're experiencing today is an event response similar to the economic reaction we saw with the dot-com and 9/11 crash. So that we can compare those side by side. We take a look at the dot-com and 9/11 crash, we see the S&P correction, but during that span of time, there was nearly a 24% home price appreciation. So what this shows is that it's reasonable to expect that the housing market's going to react like it did during the dot-com and 9/11 crash, more so than it did during 2008. All right, question number 3, are we headed for a recession? The most important thing with this question is realizing that a recession is simply a slowdown in economic activity. And this is going to occur for various internal and external reasons. In regard to recession, let's take a quick look at a statement by Bill McBride. With the sudden economic stop and with many states shutting down by closing down schools, bars, and restaurants, my view is that the U.S. economy is now in a recession and GDP will decline sharply in Q2. The length of the recession will depend on the course of the pandemic. The thing is that when we hear that word recession, people tighten up and they get that feeling of dread because we're still so tied to the devastation that happened in 2008 for our economy and so many families that were impacted by that. And like I said earlier, the conditions that we created, that perfect storm, so to speak, and if we run with that analogy, 2008 was really like that hurricane that just ripped the economy right out of the ground and ripped out the foundation that took years of rebuilding. We learned several lessons as a government and as people during that time, and that put us in a better position to handle today's recession. So today what we're facing is more like a heavy snowstorm that's hard for people to see through. But once that storm clears, and it will, our foundation is still going to be standing. It's still going to be there. People will be ready for immediate business, and people are going to want to get out. So what's that going to look like for our economy? Let's take a look at what Wells Fargo says about that. We do not expect a repeat of the severe recession of 2008-2009 because the virus and oil shocks are not endemic to the financial system, but rather external. Once the virus infection rate peaks, we expect a recovery to gain momentum into the final quarter of the year and especially into 2021. Looking at this graphically based on Goldman Sachs GDP forecast, we can expect a V-shaped recovery during this recession rather than what happened in 2008 that took years of rebuilding because of that internal situation that we created in our economy. So on that note, before we go to number 4, let's take a look at one more slide. And this one is a huge one that a lot of people aren't aware of. In 3 of the last 5 recessions, we've actually seen an increase in home values. So the important takeaway here is realizing that recession does not equal a housing crisis. Okay, last but not least, let's tackle number 4, and that is, how do we know this is not going to turn into another 2008? In other words, what specific indicators do we have that show us why this is not like the last time? Okay, so I'm going to run through the next 5 slides pretty quickly, but I'll direct you to a recent blog post that I put on my website that covers each of these in more detail. These graphics are also included here for you to download, like I said, and they all this one all points back to that perfect storm that we have been talking about and those lessons that we've learned as a government and as consumers. So, okay, number 1, mortgage standards are not what they used to be. Leading up to the crash, mortgages were much easier to obtain, and you can see during the housing bubble, the higher the index, the easier it was to get a mortgage. So you can see how that's changed today. 2, prices aren't soaring out of control. Normal appreciation is 3.6%. So you can see in the years leading up to the crash, appreciation was way out of pocket. Number 3, we don't have a surplus of homes on the market. We actually have a shortage right now. 6-month supply is a balanced market. Anything over that creates overabundance and causes home values to depreciate. So you can see right now we actually have a shortage, which means values are going to continue to appreciate. Okay, 4, houses became too expensive to buy. 14 years ago, prices were high, wages were low, mortgage rates were over 6%. Today, prices are still up there. Wages, however, have increased, and the mortgage rate is about 3.5. Today, I think we're at about 3.9, depending on when you're looking at this. We've been kind of fluctuating in that high 3, low 4 range. So that means average family back then or today pays less of their monthly income towards a mortgage payment than they did back then. Finally, number 5, People are equity rich. They're not tapped out. In the run up to the housing bubble, homeowners were using their homes as personal ATM machines, and prices have risen over the last few years, but consumers have learned to not cash that money out and hold on to their equity. So this has led to numbers being at about 50% of homes in the country having retained greater than 50% of their equity as it stands right now. So, all right, guys, so the bottom line is that the same formula that led to 2008 isn't the same formula that we're using today. And while we're facing an external emergency, and it is a very serious situation that my family and I take serious as well, it will come to an end, and we will bounce back, and we can expect to be stronger in much less time than we have in the past. Okay, I'd like to end by saying I know we're in uncertain times right now, but I hope that this has brought some clarity to at least a few of you. Please follow the recommended guidelines for safety and social distancing while we work through this time as a national community and as a world community. So if you guys have any questions or there's other information that you guys want to see, please let me know, and I'll do my best to provide that for you. All right, guys, be safe.